A very warm good evening to one and all. I welcome you all in today's internal audit study group on overview of AIF regulations by SEBI. And for that, we have our learned speaker, CA Apeksha Shah, who is again an internal auditor, seasoned professional. So, friends, it is around 9 months the new team has taken over under the respected chair. I've been given the opportunity to lead internal audit committee of WIRC. CA Ketan Sayya sir is also here with me. May I request, today we are in AI conference. We are having 2 days AI conference at Yogi. So we are addressing from there. So may I request CA Ketan Sayya sir, chairman of WIRC of ICAI, to come and address us. Over to you, sir.
Thank you so much, Jinal Madam. Uh, Fantastic, evening ahead, and we have, a very learned speaker in the form of Apeksha Madam, and I think a very knowledgeable session ahead. Let me place on record sincere thanks to Apeksha for her valuable time given to the Western India Regional Council and for this study group meeting. Thank you so much, and I'm sure that all of you must have registered for the regional conference. If not, please register. It is happening on 19th and 20th December at Geo World Convention Center. And it is one of the important event which is going to happen of WIRC. So welcoming all of you to this study group meeting. Thank you. Thank you so much. Over to you, Jinal Madam.
Thank you, Chairman sir. As rightly said by Chairman sir, we are looking forward to have you all in regional conference held to 19th and 20th of December at Geo. Apart from this, at internal audit committee, we are doing various initiatives, various activities. So one was basics of internal audit program. Second was 2 day conclave on future proofing internal audit profession, where me and Apeksha met. So from there, we took up this session. Apart from this is fourth or fifth session of internal audit study group. So looking forward for your valuable contribution wherever our beloved productively. With this, may I request our today's leader, C. Apeksha Shah, to come forward and start today's session. Over to you, Apeksha. Thank you.
A very good evening to each and every one of you. I would like to extend my thanks to Ketan Sayya sir and Jinal Savla ma'am for giving me this opportunity. Today we are going to speak on the AIF regulations, and this topic is dear to me because I have done a lot of work in internal audit under this industry. Uh, just to take you through a background of what we will be going through today would be that, we'll be discussing the complete regulation perspective of AIF. I would also try to draw some parallels of AIF to the mutual funds and why internal audit is becoming important in this industry. Also, we would be, if time permits, go through the internal audit aspect of various regulatory requirements and come to the operational requirements also. So apart from the regulatory requirements, in the end, I would like to cover some operational areas wherein the internal audit perspective will be discussed. I'll be sharing my screen so that the presentation is visible to everyone. Is my screen visible?
Yes, yes, Apeksha, it is visible.
Yeah, so coming to the AIFs, now why do we need to have a separate session for AIFs? So the need for this session is because the way in which you can see in the charts presented in the last 5 years, the investments that are coming into the AIFs have more than 3 times doubled. Okay, so they have increased 3x plus in the last 5 years. Now, from these pooled investments, there are a lot of sectoral deployments happening through AIFs, majority of that being in the real estate. That is but natural to have it in real estate also, because mostly the mutual funds would take care of the listed investments. But when it comes to unregulated and unlisted equities, or a different section of investments, AIF is a preferred mode. So due to this growing investments and the sectorial developments that the investments are commanding, a complete session we thought of having it on AIFs. Typically, why would an internal audit now be required for AIF? Though it's not mandatory beyond a particular scenario to have the internal audit of AIFs done. A lot of management decisions are in favor of this because the investors are asking for it. The investors generally would want transparency and would want to have a third eye saying that the AIFs are functioning within the regulatory ambit. So that is one reason why internal audit is gaining popularity in AIFs. And also, to have a proper risk mitigation mechanism to view the unlisted and less regulated assets here. See here, what you're seeing is a typical structure of an AIF. So what happens in an AIF is all the investors pool in the money into AIF in a common pool. And the AIF then starts investing this money into different portfolio companies. The structure of an AIF generally is a trust. Though very rarely we do see LLPs also, but majority of the times the structure would be in the form of a trust. So this is a mechanism of pooling in the money and then deploying it to different portfolio companies for investments and better returns. Here, one practical aspect while taking up any internal audit assignment would be to check the independence. See, sometimes what happens is a CA firm is taking multiple types of assignments, say statutory audit, internal audit, and any other tax consultancy or other work, right? So we also have to evaluate whenever we are taking up a new AIF assignment into internal audit that the investee companies in which the AIF is investing, what is their investment in those investee companies, and also if the CA firm is already doing any business with those investment companies. So from that perspective, we need to evaluate before accepting the internal audit assignment so that we do not breach any of our independence criteria. Typical names that you will find in the AIF, industry is a settler. Settler is somebody who settles the trust and would have, the initial investments and settlements drawn. When we come to the word trustee, trustee is a person who's entrusted, an entity who's entrusted with ensuring that the AIF functions according to the mechanism placed in the PPM. Contributor is the investor through whom we are aggregating all the capital commitments. Sponsor is typically skin in the game. So the sponsor is a person who actually designs the whole fund and would also have his own investment in the fund to ensure that the investors gain confidence in the complete mechanism of the investment. Investment manager is a brainchild of the AIF who decides about how the investment activities will happen and in what proportion, when will be the right time to enter and exit a particular investment. So these are some common terminologies which we use in the AIF's industry. See, one of the key reasons to regulate AIF space is to, drive the capital which is coming in such a force into proper desirable sections of the economy. So that is how the regulation of AIF came up in 2012. Now, what we would also like to discuss here is typically why was the AIF developed? We already had mutual funds, which was catering to all the needs. Say a mutual fund, you can invest from 100 rupees till endlessly. Why was the need of AIF as a separate vehicle of investments required? So imagine a situation where there are HNIs, ultra HNIs, who want to invest a large sum of money. They have already had their own share of, capital market investments, which are into listed NCDs or listed equities, right? So they have already exhausted that particular investment category. Now they have a chunk of money, which is, say, about a crore and more, and they are having a little bit of more of a risk appetite where they would want to get into investments which are not very traditional. So to cater to this specific requirements, we have AIF as a vehicle wherein these kind of investments are catered to. So when you see that mutual funds are of various types, like hybrid mutual funds, equity oriented mutual fund, debt mutual fund, a mix of more of debt and less of equity, depending on those risk categorizations. You will have those types of mutual funds. Similarly, what we also have is different variations in your AIFs. They are termed as category 1, 2, and 3. Typically, category 1 AIFs would be the AIFs where investments are done in startups or SME sector. Category 3 AIFs are those AIFs where the investments are more complex in derivative products or hedge products. Category 2 is typically a residual category where things which are not falling under category 1 and 3 will all fall under category 2 AIFs. So this is how the AIFs are bifurcated into. Um, the basic difference between the mutual fund and AIF from the investment amount perspective is mutual fund is for everyone. Even as low as 100 rupees investment can be done in a particular scheme of mutual fund. But when you come to AIFs, a minimum commitment of 1 crore is required per individual investor. So typically it caters to all HNIs. Also, the risk-taking capability of the AIF investments is much more than what you have in your mutual funds. When the risk is high, the returns always will be higher. And liquidity, when we talk of liquidity, it depends upon which fund you are investing into. If it's a category 1 or a category 2 fund, they are called as close-ended funds. Close-ended funds means the funds in which you have a fixed tenure, that it will start at this particular time and it will end in, say, 8 years or 10 years, which will be defined in the private placement memorandum, PPM, which is registered with SEBI. So CAT 1 and 2 are typically close-ended. CAT 3 funds can be either open-ended or close-ended, depending on their investment nature. Now, another important differentiation is the taxation aspect. Uh, from taxation perspective, CAT 1 and 2 are called as pass-through entities. That is, the fund is not taxed. Everything is taxed in the hands of the unit holder, that is the investor. So all the income that is generated out of the investment activities of this fund will be taxed in the hands of the investor in category 1 and 2 funds. But in category 3, the funds are taxed. So the fund will be given the highest slab of tax, which comes to 42.7% after including all the cess and everything. And the post-tax returns are distributed to the investors. And for the investors, it is a tax-free return. So when I was mentioning, about different categories of fund, right? Category 1, 2, and 3. So let's elaborate more on that. As I always, already mentioned that category 1, 2, and 3 have a different focus of investments. So that has been already explained in this slide. Typically, you will see, in category 1, the fund types are all the special situation funds, the venture capital funds, um, social venture funds, startup funds. Those are the categories in which category 1 AIFs will be catering to. Also, there is a subcategory to category 1, which is called as the accredited investors angel funds that will be coming to in more detail in the next slide. Category 2 would be, kind of investments where you are having investments in the real estate funds or a private equity, private credit fund. It also has a fund of fund. Fund of fund is typically, a fund which is investing into another fund. So it is called as a fund of fund. These all categories will be falling under category 2. And category 3 is, very categorically hedge funds or derivative-based products, which has got complex investment objectives. Here we have listed a few notable names of different categories of AIFs, though there is no investment recommendation in these. Now, unlocking the differences between all the three categories of the funds. So here, see what you see is typically category three funds are complex funds and into derivatives. So they would be more of a higher risk. And what I have recently seen is they are also offering better returns in current scenarios because they are all hedge-based derivative products. So of course, how the markets are functioning, the performance of the fund also would be according to that. But in recent times, in the last 1 or 2 years, the private credit fund and the category three derivative based long short funds are gaining too much of popularism. So, because of this, if you can see on the slide and observe that the sponsor investment, that is the skin in the game, requirement of category three is also higher as compared to category one and two. So category one and two are required to, have 2.5% of the entire investable corpus as the sponsor investment, or minimum 5 crores, whichever is lower of the two. One and two will have these requirements, whereas category three would be required to have 5% of the corpus or 10 CR, lower of these as the sponsor fund. Also, when you see the concentration norms, what you mean by concentration norms here is how much of an investment the fund can make into a particular investee company or a portfolio company. So typically the concentration norms for CAT 1 and 2 is restricted to 25% of the total investable fund, whereas in CAT 3 you cannot invest more than 10% of the entire investable fund into an investee company. More than 10% will not be allowed. As far as permission to invest in out of India investments would be typically based on the permissions which SEBI has granted on a specific fund. So it is not a general permission; it is a fund-to-fund approval that is required to be taken. Um, Borrowing limits. So we will see in detail in the following slides that the borrowing limits have been, stringent, and how you can borrow across funds has been, restricted to a particular requirement. So a borrowing in a fund can be done only to fulfill temporary requirements. You cannot borrow and invest. Investment has to typically happen only through the contributions received from your investor. In case there is a contribution which has got delayed from your investors, to bridge that temporary gap, you can have a borrowing and then invest. But these kind of borrowings cannot happen more than 4 times in a year. And also there are some cooling period requirements, which we will see in the later slides. So category one and two have restricted borrowings, but category three, because of their nature of hedging requirements, will have a relaxed leveraging and borrowing rules prescribed to it. Again, the SEBI registration fees differ. Again, you will see that, category three is being asked to have a higher registration fee of 15 lakh, though the per scheme filing fees are same across all the categories at 1 lakh. Now, as I mentioned, there's a subcategory to category one of AIFs called as angel funds. Now, why this angel funds? So these angel funds are a specific subcategory to category one, wherein all the angel investments for startups are looked into. And why we have a separate segregation in this is because we would want to cater to this segment with a little relaxed disclosure requirements and relaxed structure. So the minimum ticket size reduces from 1 crore to 25 lakh. The minimum fund size, is restricted only to 5 crores. It is again a close-ended fund. It cannot be open-ended fund because category one and two are always close-ended funds. Investments in this should not be less than 25 lakhs and not more than 10 CR with a minimum lock-in of a 3-year period. The sponsor requirement, the sponsor commitment is also only up to 50 lakhs. Investors will all be angel investors. There is also, a fee structure that is separately being prescribed for the angel funds. So that is the SEBI registration fees are coming to 2 lakhs of the amount. Now, this is regarding the SEBI registration fees. Now, how do a typical AIF function? If the AIF is conducting all these activities, what is the revenue for that AIF? So typically the revenue for the trustee company and the company who is actually doing this activity, investment business, is a management fee. They charge the investors a simple management fee to undergo all these activities and help you with the investments. Typically the fee currently what we see is in the structure of 220. What do you mean by 220? 220 would generally mean a 2% of management fees with a 20 carry. So there will be a hurdle rate of say 12% when a corpus gives you a return of more than 12%. On the increased return, the management fee will be, a little higher. So apart from the 2% standard management fee, what the investment manager will also charge is the uh, extra 20. So 220 means 2% of management fee and 20% of success fee. Success fee will be charged only if the fund crosses the hurdle rate returns and only on the portion which is beyond the return over and above the hurdle rate. For that particular amount, the success fee will be charged. So that is how you term the 220 fee structure. Currently, what you can see on the slide is the life cycle of a close-ended fund. So we've always been saying, there is an open-ended fund and a close-ended fund. Cat 1 and Cat 2 are always close-ended. Cat 3 can be either open-ended or close-ended. Correct? So open-ended means the investor can at any given point in time enter the fund and exit the fund at a given NAV. Simple. But a close-ended fund, entry and exit are not freelance. There is a time period for raising the commitment amounts and onboarding the investors. Then exits are typically not allowed during the tenure of the fund. In case there are situations where death occurs or some inevitable situation, there will be a transfer, but not an exit. And exit can happen only post the liquidation. So typically what you see here is the life cycle of a close-ended fund. Majority of your investment period in this, most of the times we see that the tenure of a close-ended fund is 8 to 10 years, in which the first 1 year is, only dedicated to onboarding the customers and having the capital commitment. In the year 2 to year 8, there will be all the investment activities done, and post the, close of the tenure of the fund, there will be a exit plan. The exit can be either through liquidation or dissolution also, which we will cover in the forthcoming slides. Now, what are the internal audit considerations one must have when we are, checking the life cycle of the fund? What we need to ensure is there are certain disclosures which should be typically mentioned in the PPM, that is the private placement memorandum. The fund tenure has to be defined very clearly in terms of years. Extension of the fund, if it is allowed, then how much of an extension in number of years, and the mechanism, say a two-third majority investor consent, that has to be completely clearly mentioned in the PPM. There has to be a liquidation clause. Now, what do you mean by a liquidation clause here is that how at the exit of the fund, all the investments which are not yet liquidated will be liquidated, so that all the money from the portfolio companies are coming into the pool and then going back to the investors. So all those activities of liquidation happens in the liquidation period. All the typical nuances have to be captured in the PPM under the liquidation clause for this purpose. There's also a mechanism called as a dissolution period, wherein the fund ceases to exist. So whatever are the mechanism of dissolution has to be typically portrayed within the regulatory ambit in the PPM. And we need to understand that, see, majority of the times the PPM would be consistent across different funds of the same trustee company. So when we do the internal audit, we need to also, have a parallels and drawing of comparison between the different schemes of different funds in the same trustee company to understand why there would be a deviation and if it is well explained or not. Coming to the regulatory aspects of the particular AIF industry, see what is happening currently in the market is SEBI is also very clear on the same that they are not regulating the AIFs as strictly as the mutual funds. Comparatively, they are thinly regulated. And because it is still evolving, there are a lot of changes in the regulation that keep coming. What I have tried to do here is summarize the major changes in the last 1.5 years so that we can discuss those and also understand how we would want to, take this from the internal audit perspective. Also, what I would like to mention one more thing is that any key management team member of the investment manager has to have a NISM certified clearance. So that certification of NISM is required to undergo the investment objectives. Today, from the regulatory perspective, what we would be looking into is the standardization of the valuation. So when it comes to the valuation of the AIFs, how do you value, how do you arrive at the NAV? There has to be a standardization. So SEBI has come up with clear norms on how to do the valuation of different categories of AIFs. Also, we will be looking secondly into the dematerialization norms. Initially, when AIF came into existence, dematerialization was not mandatory. How all this started and where we stand at this point in time, we'll be discussing in dematerialization of AIFs and also dematerialization of the investments that you hold in your investee company. We'll also be looking into the unliquidated investment policy. So at the end of the tenure, if there are any investments which remain unliquidated, how do we want to cater to those and what are the regulations pertaining to those will be discussed. There are regulations specifically for borrowing tenure and borrowing limits. We'll be discussing those. There are requirements of enhanced due diligence in specific scenarios, like if you are a qualified institutional buyer or if you have investors who are regulated entities, there will be a scenario where a specified due diligence is required. We will also look into those regulations. Then came the very famous equitable rights and return allocation, the pari passu circular, which got a lot of industry traction. We will be discussing that circular also. And most recent updates in the last few days, which have been across the co-investment through AIF structure and rationalization of angel fund regulations will be looked into. So these are some specific regulatory requirements, which I'll be discussing one by one. I will also try and emphasize on the internal audit aspect of, when you're doing the audit of these AIFs. We'll look into from the regulatory aspect, we'll link it to the internal audit checklist also. Now, standardization of valuation. See, as I mentioned, valuation was being done by different AIFs in different methodologies. Now, what was happening is a particular investor will not have a comparable NAV. Suppose there is an investor who is evaluating that, the NAV of two different real estate funds. If there is no standardization in the methodology, you will not be able to have a comparable NAV and you will not be able to make a very informed decision on your investments. So hence, SEBI came up with this standardization norms, where SEBI said that the valuation has to be done by a SEBI registered independent valuer. The term independent here is very important. We have to understand that the valuer has to be independent and not associated with the fund or the fund manager or no control over investment decisions. Also, rotational requirements of the valuer has been put into place. So a particular valuer would have to rotate out and a new valuer would have to come in. That is also mandated by SEBI. And what the investment committee and the trustees have been entrusted with is once you have the valuation reports from the valuer, they need to review those reports and minutize that in their investment committee meetings. Now, coming to the technical aspects of the valuation, how typically would the valuation be done? So, for all the listed investments, valuation will be carried out as per the regulation which is applicable for mutual funds. But when it comes to unlisted investments, you do not have a BHAV copy readily available. There is no everyday price movement that you are tracking. So, how do the valuations happen here? So there is a body of AIF who represent 33% of more of the industry representation. Through that body, there are some valuation norms which have been highlighted, and for unlisted, those norms will be followed. And the AIFs have to report the valuation data based on only the audited financial statements of the investee company. So from 31st October, what has happened is whenever AIF is doing valuation of a particular investment, they have to take the audited financials of that investee company and base their valuation numbers only on the audited financials. So here, the role of the manager is to ensure that there is no deviation and there is a true and fair methodology to the NAV. Also, SEBI has come up with, disclosure requirements wherever there is a change in valuation. What do you mean by change in valuation here is, say in two consecutive valuations, if you're doing a quarterly valuation, suppose in Q1 and Q2, the difference of valuation is more than 20%, then that is termed as a change in valuation. Similarly, in any financial year, even if they are not consecutive valuations, if in a financial year there are valuations which has increased by more than 33%, it will be termed as a change in valuation. So these changes have to be informed to the investors in a specific manner, along with reasons, asset specific reasons for the change of more than 20% or more than 30%. Also, if there is any change in methodology of valuation, suppose you've been valuing a particular investment on market rate, and then there's a change in valuation methodology to discounting cash flow on prospective income, then these change in methodology has to be communicated to the investors and it has to follow the investor consent process. Who can be the valuer is highlighted on this slide, and the specific mention of independence has to be remembered. So when we are doing the valuation from internal audit perspective, what do you think is required to be done? See, usually different methodologies are adopted for the funds. Now with this, what we see is majority of the times there is a industry benchmarking process that is taken for unlisted. So whenever you go into unlisted equities and ventures and those kind of investments, you need an industry benchmarking. From where will you get that industry benchmarking? To have your comparable valuation is through the rating agencies. Nowadays, CRISIL and other rating agencies have come up with these kind of press releases, which are readily available, where they do the AIF benchmarking across different categories. From from the internal audit perspective, what we need to ensure here is the valuer appointed is independent. How will we check that is through the independence declaration and the appointment letters that have been issued to them. We also need to ensure that the rotational policy is followed here. We need to understand the valuation methodology and if there is any change in the methodology, how we have abided to the requirements of the regulation for the change in methodology, if it has been followed correctly or not. That has to be seen and verified. Valuation frequency, generally category 1 and 2, SEBI has mandated once in 6 months. Category 3, for close-ended, it is quarterly valuation. Category 3, open-ended, has to be monthly valuations. Now, any extension in the valuation can be possible only in category 1 and 2 funds. Category 3 funds mandatorily has to do open-ended monthly disclosure of NAV, and close-ended in category 3 has to be quarterly. Category 1 and 2, though SEBI has said minimum, it has to be a half-yearly valuation. An extension to annual valuation is allowed provided you have majority. Majority here means 75% of the investor consent. So as an internal auditor, what we need to ensure is the valuation is happening as per these laid down frequencies. And what we also can do is, at least, though it is being done by a expert in this section, so independent valuer is doing his job. What we can extend our checks to is at least the data integrity part. Whatever data, the input, the source data, we can validate those. Because if there is an error in providing the source data to the valuer, the valuation will go for a toss. So at least those checks as an internal auditor we can do. And also we can see that how the investment committee is minutizing this in their meetings. Coming to the next regulation is of the dematerialization. So when initially AIFs had just started, right, dematerialization was not mandatory. As we speak today, all the investments and all the units of the investors are in the dematerialized form. This has been a phased manner mechanism where as on today we will see that even if there is an investor who is not disclosed a particular demat information to the AIF, there's an escrow account, aggregate escrow account, where all the units have to be parked. So as on today, everything has to be in a dematerialized form for AIFs. All the units of the investor, as well as whatever investments the AIF is making, everything has to be in a dematerialized format. The specific timelines for those have already been achieved. I have already mentioned that in my presentation here. When we come to the internal audit considerations for dematerialization, what we should be highlighting is the need for the DP agreement and ISIN creation letter, the investor consent and all the KYC forms for dematerialization. We also need to look into the reconciliations in case there are any unreconciled items, any units still long standing in the aggregate escrow account. We need to understand and monitor the efforts done by the company. And once we have the DMAT information, the units have to flow from the aggregate escrow account to the individual DMAT account within 5 days. We need to also check the compliance report pertaining to these and how the disclosures have gone to the CTR as regards dematerialization of units and its complete flow. So that's on the dematerialization requirements. Next, what we can come to is the unliquidated investments policy. Now, what do we mean by this? Unliquidated investments. So when a AIF has invested into different portfolio companies, right? There is a time period for close-ended, after which the obligation is achieved and the investment objective is achieved, and we need to liquidate those investments, pull the money from the investment company along with the returns and pass it on to our investors. So, in some scenarios, what happens is the fund is not able to liquidate all the investments at the right point of time. Due to liquidity issues, some investments remain unliquidated. What SEBI has come up with now is a separate liquidation scheme is not required. Initially, what used to happen is AIF had to file a separate liquidation scheme to cater to these unliquidated investments. Now, what SEBI has asked us to do is the AIFs can only have an unliquidated investment policy. And according to that policy, there is a vehicle which is established and all the liquidation takes place in that form. So typically, what would happen here is first, the AIF and the investment manager will need to take a pool of unliquidated investments and arrive at the 25% amount of that pool. That is figure X. Then get a investor consent, majority investor consent of 75% or more in order to enter into a dissolution period. Once he has both, the fund enters into a dissolution period and the dissolution process starts. Before this, there is a liquidation period where the fund is only trying to liquidate the investments. Let us see in detail how this liquidation takes place. So if the bid value of 25% of unliquidated value and the dissenting investors will give you a full exit, you can have a pro rata exit from the residual bid. That means once you have arrived at that 25% of the unliquid pool, all the investors who are not agreeing to a dissolution period can get an exit from that 25% of the pool because you have offered it for a bid. And if there is some residual money left after the bid amount has been distributed to the dissenting investors, that can be given to the other investors on a pro rata basis. So, and once the dissolution, so liquidation takes place like this, but in case there is, the investors do not agree to this, then the value of rupee 1 ad hoc is given to the bid and the complete investment has to be written off because there is no extension to a dissolution period after the tenure of the fund. So typically speaking, if the investors consent and we get the bid amount, then the liquidation process starts and the whatever investments are being able to be liquidated are passed on, the liquidation proceeds are passed on to the investors. In case this is not possible, then in specie, uh, dissolution also happens, wherein the asset is given as it is to the particular investor. There's a separate process aligned for the same. Now, what are our internal audit considerations when we come to unliquidated investment policy? First, we need to identify what are the unliquidated investments and apply a rationale on those list of items that why it remains unsold. Then we need to assess the route of decision, whether the company has taken a route of liquidation or dissolution or in specie. This will be communicated to the investor. Investor consent would have been taken. So that process needs to be evaluated in detail. Investor consent. So we have had assignments, where our client has requested us to completely check a process of investor consent and to ensure that when we are saying that we have majority consent of 75%, they wanted the internal auditor to evaluate and assess that 75% when the management is saying it is actually 75% and not less. So that came up as a separate assignment. That is how important this 75% consent in the liquidation process is. So that we need to ensure that anything which has to happen only after the investor consent, the right consent has been obtained at the right percentage and in the right manner. How we have, issued letters to take the consent, what was the content of the letter, have we informed the investor on all our aspects regarding, the liquidation, the asset, the shortcomings, and have we informed them on the bid arrangement? So all those things are very important. When the mandatory in-specie distribution is triggered, what we have to ensure that the fund is the value of that investment is recorded at rupee 1 record value. That is compulsory. All these things have to be very clearly mentioned in the PPM or across the PPM, for the period of liquidation, period of dissolution, methodology, the consent percentage, everything has to be very clearly coming up in the PPM. And the trustee or the manager accountability has to be uh, seen in practice. So it should not be only in document, but in practice also we need to assess whether they have done their sign-offs correctly or not. Typically, this is a graph which is highlighting the liquidation and dissolution timelines. Coming to the next particular regulatory update here is the borrowing reforms. So initially what happened is temporary operational need borrowing was allowed for a period of 30 days. That was the only simple requirement. Now SEBI has gone one step further and highlighted that the new provision will allow the AIFs to borrow temporary shortfall in drawdowns also. So apart from operational needs, not capital needs, temporary operational needs, apart from that, the fund can have borrowings for shortfall in drawdown. So what happens here is, say, I have asked a drawdown. So I've called for money from the investors at an X amount because I see an investment opportunity in a portfolio company for the similar amount. So I have done a commitment with my investor company that I will be, say, deploying 10 crores by this date, and this is my return expected. That deal is locked. I have called for a drawdown for that to all my investors, and say two investors are not able to fulfill that drawdown in the given timeline. It is not a default. They have not said that I don't have money to fulfill my commitment amount. But what they're just saying is, I will not be able to provide this money by, say, the given deadline as you have prescribed. I will require 20 days more. इसमें what will the fund manager do for those 20 days and that limited shortfall of say 1 lakh or 2 lakhs? He will not be, it would not be prudent to miss the investment opportunity. So for this kind of a shortfall, which is not a permanent default, a borrowing is allowed by SEBI. This is what SEBI has clarified in its recent borrowing reforms. So that particular borrowing can happen, but overall, there are limits to borrowing. So my maximum borrowing can be least of the three. What three? That is 20% of the proposed investment in the investee company. मुझे जो investment करना है in the investee company, if the shortfall is, amounting to 20% of that particular portfolio company investment, I can do that much borrowing. Or 10% of the complete investable funds across portfolio companies in that fund. Or my pending commitment drawdown from the non-defaulting investors. Least of these three can be borrowed, and the borrowing can happen for a specific period of time and not more than 4 times in a year. Also, there is a crucial cooling off period, which, in case our company is doing borrowings as internal auditors, we will have to ensure that we check this particular trigger, that a 30 days cooling off has been kept. So the time from which I exit one particular borrowing, I repay that borrowing and I go into the next borrowing, there has to be a gap of 30 days. In that 30 days, I shouldn't be having any borrowing. That is one crucial objective that we need to ensure. So yeah, this slide is detailing other crucial checkpoints from internal audit perspective in case the borrowings have been triggered in the AIF. So the borrowing policy has to be disclosed very clearly in the PPM, and we have to ensure adherence to the PPM. Borrowing purpose has to be only for this purpose, and practically we need to ensure that there is no such mechanism where again and again we are trying to accommodate a few investors to cater to their non-funding positions. So it should not become a habit, and that is why these limits of borrowing maximum to 4 times in a year and the cooling off period, so that it is not taken up in a wrong way, and it is not catering as a funding requirement to the defaulting investors. Approval mechanism, disclosure requirement, drawdown commitment reconciliations, these all have to be actually minutely scrutinized in our internal audit aspect. So whenever we get into the scoping of our internal audit, it becomes very crucial to actually incorporate all these details in the scoping and checklist of the internal audit of AIFs. Coming to the next specific regulation is scenarios where specific due diligence is required. So the regulator has mandated AIFs to get into specific due diligence in few scenarios. One such scenario is QIB and QB due diligence. So when I talk about QIB and QB due diligence, it is the qualified institutional buyers or qualified buyers. Now, why has this particular regulation come into force is because by its nature, if an individual is a QIB or a QB, they get a lot of relaxations and perquisites and advantages. Okay, a particular individual I'm talking about. Now, say there is a particular individual who is not a QIB or a QB, and he goes as an investor into the AIF. AIF by nature can be categorized as a QIB or a QB. But what SEBI wants here is any investor who is a part of an investor in the AIF but not entitled to QIB and QB rights and advantages in their individual capacity should not get these kind of rights through the AIF module. To restrict that particular mechanism, SEBI has come out with specific due diligence guidelines, wherein the due diligence is triggered if 50% or more of the contributing investors are QIB or QBs. From that trigger, a due diligence would be required to be done. And if, depending on the outcome of the due diligence, if it is eligibility conditions are met, then the AIF manager will have to provide a written confirmation to the stock exchange regarding availment of these benefits. And further disclosures as per the QB for the ARCs will have to be made under the SURFACI Act. So this is one trigger of QIB and QB for due diligence. Another trigger for due diligence is a scenario wherein SEBI wanted to restrict evergreening of the assets. Now, try and understand a scenario where a particular investor of an AIF is a regulated entity. A regulated entity means, say, NBFC. So it is a regulated entity by RBI and is an investor in an AIF. And that person is also, in his individual capacity, a lender in a company X. Now, this AIF, where he's an investor, has an investment in that company X. Now, are you understanding what is happening? An investor is an investor through AIF in a company, and in his individual capacity, he is a particular lender in that company. This will trigger a evergreening of assets wherein a particular stuck lending can be liquidated through investment inflows. To restrict this kind of mechanism, again, a due diligence mechanism has been triggered by SEBI, wherein, depending on the outcome of the due diligence, disclosure requirements in the PPM will have to be made. And if the due diligence fails in this case, AIF will either have to restrict that investor from the investment portfolio or would have to completely uh, not go ahead with that particular investment in the company X. This is what SEBI has asked to do. So this due diligence is very critical in case there are regulated investors in the AIF. The third trigger for due diligence could be a land border countries. So what happens is a person who is resident outside India may subscribe for purchase, sale of equity instruments of Indian companies in the manner and subject and terms and conditions specified in the NDI rules. This is when a person comes in his individual capacity. Now, if he is going through a AIF structure and coming to an AIF as an investor, but he is a resident outside India, specific due diligence to ensure those criteria will have to be conducted. And depending on the outcome of this due diligence, the disclosure requirements to the custodian and to the investors will have to be made in a standard setting format. There is a SFA which SEBI has outlined. That's a standard setting format. In that, the disclosures of due diligence have to be reported to. So this is the third scenario where specific due diligence would be mandated in case of uh, you know land border countries where the investment is coming from person outside India, resident outside India. Now the most famous regulation, which is the pro rata pari passu rights. Now, what do you mean by pro rata here? Pro rata means the proportion in the same proportion as your capital commitment. And pari passu means equal footing. So every investor will get rights in proportion to its commitment and should be given liquidation and drawdown in equal footing. And there should be no differential treatment between the two types of investors. Why did this come into force is because SEBI had noticed a few scenarios where there would be special treatment given to some investors through side letters. A typical mechanism for investment functions is through PPM. Everything is detailed in the PPM. All your management fees, your rights, your obligations, your duties, everything is in the PPM. But what the companies would sometimes do is get into a typical side letter with a particular investor and would give him a favoring or advantageous position. Sometimes also what would happen is if an investor is also a co-investor with you, your client is customer is also a co-investor, then there would be a differential treatment. To put a curb on all these things, SEBI came up with a circular for pro rata pari passu, wherein they have enlisted all the regulatory requirements which the scheme has to follow for distribution of the proceeds. And SEBI has also set up a scenarios of exceptions, like if a particular investor has defaulted on his commitment, then of course you cannot have him on the equal footing as the commitment amount because he has defaulted already on that commitment. So these kind of an exceptional scenario has already been taken care by SEBI. But the intent of the regulator here is to have full transparency and equal rights to all the investors here. Coming to one more recent regulation is the co-investment framework through the AIF route. Initially, what used to happen is now let me tell you what co-investment typically is. Uh, as we all have learned in the beginning of this presentation is once all the money of the investors is pooled into the AIF vehicle, what AIF will do is deploy these as investments in different portfolio companies. Now, say a particular investor has invested in a AIF and through that in an investor company, but he still has some surplus funds which he does not wish to put into AIF any further, but would want to put into that company directly as an investor. Then it is called as a co-investment. That means an investor is investing in a company X in his individual capacity also, and also through co-investment mechanism. Correct. So this is how a co-investment is defined as. Now, initially, what used to happen is co-investment would happen only through PMS route. PMS is Portfolio Management Services route. That is also a different regulation for in to meet the different investment objectives of SEBI that we can see at some later stage. It's a very lengthy regulation. So initially, co-investment in AIF was possible only through the PMS route. Now, SEBI has set up a framework where co-investment can be done through the AIF route itself. So there would be a co-investment vehicle scheme which is set up, and this is possible only in category 1 and category 2 funds through that accredited investors. So those investors would have to take a accreditation from SEBI, wherein they will be labeled as a accredited investor, and then can enter into a co-investment scheme through the AIF route. Here, what is very important is to have segregation of assets. So every CIV scheme, CIV means co-investment vehicle scheme, will have its own bank account and its own demat account, and the assets have to be ring fenced from other schemes to have a demarcation. That's a very important regulatory requirement here in co-investments. So by now we have covered all the major regulatory updates which are required to be done and which have come into force in the last 1.5 years. There are few smaller regulatory updates which could be meaningful, which I've tried to collate in these particular two slides. Uh, Accredited investors in India, how a certification will be taken. So there is a particular process wherein a accredited certification from SEBI can be taken. Why is this important is because accredited investors have a lot of flexibilities. SEBI gives them a lot of exemptions and advantages. But the schemes, now schemes can have both type of investors, general and accredited. But those schemes which have 100% accredited investors have a lot of flexibility in terms of thresholds. There are a lot of advantages wherein the minimum capital amount and also the maximum investment limit per company, those are all relaxed when the scheme is catering to only accredited investors. So that is one regulation which has come up. Another pertains to the trail commission. Now, what is trail commission? Let me just explain you that piece. How do these AIFs onboard the investors? There are different distributors, more like brokers. So they will have the connects and they will bring the investors to invest into a particular AIF. What will these distributors expect in return is their commission. So initially, what used to happen is SEBI was allowing upfront commission as well as trail commission. Upfront commission means, say, once I get the investor and he commits an amount, the distributor will be given, say, 2% of the commission. And then balance commission will flow in, say, next 4 years in equal installments. That used to be the mechanism of distribution model initially. Now, what SEBI has done is for category 3 funds, there is no upfront distribution commission payable. You will not be allowed to pay any upfront distribution to your distributors. You can only pay it in trail in equal installments in a particular defined period. So, say 25% of the commission in 4 years equally. That was mandate, that is allowable. But in category 1 and 2, what SEBI says is 1/3 of the fee you can pay upfront, and the balance you can distribute it equally amongst the defined period as trail. But in category 3, upfront is completely stopped. Also, SEBI has come up with a requirement of direct plan. Now, what do you mean by direct plan is a plan where there are no distributors involved. So a person can directly come and register in your AIF and not he will not be charged any distribution charges or placement fees. So what SEBI has done is it has mandated the schemes to have a direct plan. It cannot happen that you onboard customers only through distributor model. You have to offer your investors a direct plan to be onboarded into that investment. Custodian appointments has been mandatory from Jan 31 for funds which are 500 crores and up to 500 crores. Also, the PPM audit. So, the PPM which I mentioned, which is the private placement memorandum. So, AIFs are not allowed to typically advertise their funds and, in general, do borrowing. Onboard the customers. They can only onboard through private placement memorandum, which is the PPM. PPM now has a standard format, and also there's a standardization in the PPM audit report. So, irrespective of which firm is doing the PPM audit, there is a prescribed audit report format through which the particular PPM audit report has to be released. That has to be followed. We have to ensure that our audit report follows that nomenclature. Also, SEBI has relaxed the submission of PPM changes via merchant banker. You can directly file all the changes in PPM. The AIF can file directly with the SEBI and not required to mandatorily go through the merchant banker route. Recently, there has been a angel fund accreditation investors regulation where a lot of relaxations in investment limit and caps on the investee company has been relaxed. These have been very clearly mentioned on the slide here. Another regulation which SEBI has been, I think, more than 7, 8 months now that we have been to and fro populating on is the CSCRF, that is the Cyber Security and Cyber Resilience Framework. The CSCRF audit can mandatorily be done by a certain empaneled auditor only. And there are certain requirements depending on the thresholds of your AUM, wherein the AIFs will have to cater to those particular audit requirements and also submit the periodic or annual audit reports to SEBI. But if there are small AIFs, say a corpus of up to 3,000, then a self certification will also work. So there's this detailed technical circular on how the cybersecurity and resilience framework has to be set up. What should be your committee formation? What should be the disclosure requirements? What should be your hardware module? What should be the audit requirements? All of that has been very technically elaborated in this CSCRF circular. Practically, from a firm and a practicing angle, what I have seen is there is a lot of opportunity for CA firms in guiding the client. So even if you are not a certain empaneled firm, your clients would love to have you guide them if they are ready for this particular audit or not. So helping and hands-holding the client in achieving the readiness for this audit will also be one of the aspects where we can work with the client together. We have a lot of time in hand, and we've covered the regulatory aspects. I would also, like to touch base on the operational aspects of AIF in internal audit. So, what is a typical structure in which the AIF
Hello, hello. I think there is a network gone from Apeksha side. Hello, can you hear me? Hello.
I'm extremely sorry. I faced a particular network glitch. Would like to continue by sharing my screen. Yeah, so typically how a particular AIF, so all the drawdown notices would be sent to the customer against which the funds from the customers would be flowing. And as per the investment objectives, these funds will be deployed in the different portfolio companies. Now, from this operational aspect, what I have experienced and what checkpoints I feel are critical in our internal audit assignments would be I've just tried to state that in a very crisp format. When we are doing the customer onboarding piece, we need to be very vigilant with the KYC documentation aspects, the Aadhaar masking aspects. If the customer's Aadhaar is being taken, even if it is being taken, say, by a third party, if your RTA or is doing this particular activity for you, the AIFs will have to ensure Aadhaar masking, KYC documentations are complete in all respects, and AML checks. So, as an internal auditor, we need to, at least on sample basis, understand how these KYCs have been taken, how these documents are preserved, how the AML checks are being done. Are they done through a tool? Are they done through a third party? Which tool is the third party doing? How are these reports recorded? Are they accessible at any given point in time? These are some things which are important to be kept in mind. When we come to the drawdown notice, we have to ensure that timely notices have been sent to all investors. What is the mechanism? Typically, what I try to do is get into the process of how are we typically sending these kind of notices. Are we doing it through a automated process, then there is no fear of miss out. But if it is a manual process, we need to ensure that all the investors have received this notice. The mechanism of reconciliations of drawdown amount, committed amount, any pending drawdown has to be checked. Any drawdown amount which is long outstanding has to be discussed with the client, and what is the next course in action has to be verified. When we come to distribution mechanism, what we need to understand is the distributions are correctly calculated. They are reflecting in the SOA, the statement of accounts of all the clients. And we also need to understand how these distributions are timely credited in the investor accounts. For this, what will help is, if you have a scrutiny of the fund's bank statement, it will really help you to understand if, the distributions, the manner in which the amount has flowed into the pool account and how it has flowed out of the pool account and into the individual customer accounts. All the reconciliations between the units and also between the amounts of call out, drawdown, and receipts should be happening, and we should, as an internal auditor, review that specifically. A scrutiny of SOA and bank statements on sample basis will give you a depth of understanding, and it will help you get a comfort on how the movement of money is happening. Again, the related party disclosure piece is very important. The PPM requires us to mention the related parties and transactions around them. As an internal auditor, what we should be doing is to at least understand the process of identifying those related parties and the process of updating that list. There should be no miss in identification, and there has to be a correct process in which we typically update those related party list and the transactions around it. Also, whenever the operations are outsourced to a particular third party, the responsibility of compliance is always with the AIF. And as internal auditor, we should help the client in ensuring and optimizing those outsourced activities. So that would also be very, very critical. That's about it with my presentation. I would like to take up questions, if any.
So, hello Apeksha. So, from the WRC team, I will like to thank you for a wonderful session, for the wonderful insights. And from the starting only, you have told like what is the difference between the mutual fund and AIF, and the category 1, 2, 3 difference between what is like category 1 is included, 2 and 3. It was like wonderful session, and you have told like recent changes in AIF policies, circulars, and operational aspects from like as an internal auditor, which aspect we should look into this AIF funds. So it was really, really very insightful and very wonderful session. Thank you from WRC internal audit team. Thank you, Apeksha. So any questions from audience? Okay, I don't think so. There is any question. So Apeksha, we'll close the meeting now.
Thank you very much.
Thank you. Thank you so much. Thank you, audience.